Welcome back to The Deep Dive, your go-to for cutting through the noise in the latest earnings calls. Our mission, well, it's to extract those crucial nuggets of knowledge so you're not just informed, you're well-informed without drowning in data.
And today we're zeroing in on Shoe Carnival's second quarter fiscal 2025 earnings call. Now, the market certainly took notice. Shares jumped pretty significantly after the release.
It really did.
And this isn't just about beating estimates. It's, a clear vote of confidence in their strategic pivot during a time when, frankly, many retailers are struggling with top-line growth.
Right.
It tells us investors are betting on the quality of earnings and strategic execution over sheer volume.
For anyone tracking SCVL, this earnings call really delivered some fascinating numbers and, a surprisingly refreshed outlook. It's kind of a classic case of finding the story behind the data, and I'm genuinely curious to unpack what's truly driving this. So we're going to dive into those results, understand management's razor-sharp focus, and explore what it all means for the future of footwear retail.
Sounds good.
So let's get right into the headline numbers from the second quarter, because there was a clear standout here. The company delivered a significant beat on earnings per share, far exceeding what analysts had expected. That's a strong signal.
Precisely, yeah. While net sales, they did see a modest decline year over year and slightly missed consensus, the market clearly prioritized the company's impressive gross margin expansion.
Right. The bottom line.
Exactly. That's what we call a strong signal about the quality of earnings, meaning the profits they're making are coming from solid business decisions, not just, cutting corners or one-off events. It speaks volumes about their strategic execution.
So we're looking at a mixed top-line picture, certainly, but a very strong bottom-line story. And this divergence, it immediately caught the market's attention, and for good reason. It suggests something fundamental is shifting within the company.
Absolutely. Diving deeper into those financials, the company reported GAAP earnings per share, that's profit per share, calculated by generally accepted accounting principles of 70 cents.
70 cents.
Yep. Yeah, this was a robust beat, landing somewhere between 13% and 27% above the consensus range. So a really solid performance on the profit front.
And the gross margin, which you just highlighted, that was a real standout at 38.8%. That's an expansion of 270 basis points year over year, or, put simply, a significant 2.7 percentage point jump.
Huge jump.
Yeah. Management noted this was their strongest Q2 margin in years. And it wasn't some fluke, right? They specifically attributed it to disciplined pricing, a favorable mix shift in the products they're selling, and smart strategic inventory investments. Crucially, not deep discounting. That's a key distinction.
It truly is. Now, despite that impressive margin, overall comparable store sales did decline 7.5%. But here's where the nuance comes in. And it's important not to just look at that number in isolation.
Okay.
Approximately 100 basis points of that impact came directly from the 20 store rebanners completed during the quarter. So, to put it in perspective, the Shoe Station brand, which is their newer, more premium offering, actually grew sales by 1.6% with essentially flat comparable store sales.
Flat comps, okay.
Meanwhile, the legacy Shoe Carnival banner saw sales decline 10.1%. So you see the two distinct performances there.
It's a really critical distinction. Yeah. It almost sounds like a controlled decline in one area, while the other is, gaining steam.
Yeah, that's a good way to put it.
And underpinning all of this financial strength, a fantastic balance sheet. The company ended the quarter debt-free with $91.9 million in cash and marketable securities. And get this, by the end of August, that figure had climbed to nearly $150 million.
Wow.
Yeah, up over 10% from the prior year. That's a significant cash cushion.
Indeed. And even their inventory levels, which were up 5% year over year, and management, admitted was too much, they actually framed it as a luxury problem.
A luxury problem, I like that.
It's almost like they're saying, yeah, we've got a lot, but it's all the right stuff ready to capture demand. It's a deliberate strategic investment to ensure they're fully stocked on key items for the back-to-school season.
And that paid off.
And that clearly paid off, yeah. Helping to drive that margin expansion and the strong Q2 earnings beat.
It seems like every lever they're pulling, from financials to inventory, points back to one central initiative. Yeah. This Rebanner program. This is the core of their strategy, right? What exactly is this, and how is it truly transforming the company from the ground up?
You've hit on the critical point. The Rebanner strategy is Shoe Carnival's central, bold initiative, converting existing Shoe Carnival stores into Shoe Station locations.
Okay.
And this isn't just slapping a new coat of paint on the sign. It's a strategic pivot to attract a distinctly higher income customer demographic, specifically households earning over $50,000 annually.
50,000 plus.
Exactly. The goal is clear: drive structurally better, more sustainable margins by serving a customer who's frankly less impacted by economic volatility.
And they're moving fast, too. Through Q2, 44 conversions were completed year to date, with another 58 planned for the second half of fiscal 2025.
Yeah.
That brings the total to a significant 145 Shoe Station stores by year end.
That's approximately 1/3 of their entire fleet by the end of this year. And the goal is ambitious. By back to school 2026, over 215 stores, more than 51% of the current fleet, will be Shoe Station.
Over half the fleet.
Yeah. Management calls this the tipping point. Think of it like a flywheel finally spinning fast enough to generate its own momentum.
Right.
Where Shoe Station's accelerated growth is expected to systematically overtake the declines in the legacy Shoe Carnival banner, fundamentally shifting the company's overall trajectory to consistent positive growth.
We actually saw the immediate tangible impact of this strategy play out in the critical back-to-school season in fiscal August, a period that accounts for roughly 25% of their annual profits. That's a huge indicator.
Indeed, it was a significant milestone. The company returned to positive comparable sales growth company-wide during August, which frankly remarkable given the earlier declines.
Yeah, definitely.
Shoe Station was the star performer, growing comparable sales in the high single digits, particularly in children's and adult athletics, both with expanded margins.
Wow.
What's even more interesting is that even the legacy Shoe Carnival banner delivered positive comparable sales and margin growth in its children's category. It shows the strategic focus is really beginning to take hold.
And it sounds like management isn't shy about making tough choices. They explicitly stated they are managing the legacy Shoe Carnival banner as a cash generator during this transition. They are prioritizing margin discipline over aggressive promotions, strategically shifting away from the sub-$30,000 household segment. Now, while that's a clear path to protecting profitability, is there a risk here by intentionally shedding a segment of their customer base, of potentially alienating a loyal customer, or maybe ceding too much market share to competitors in the long run?
That's a fair challenge. Management's stance, though, is that by moving away from that sub-$30,000 segment, they're not just protecting profitability, but actually de-risking the business.
De-risking.
In the current economic climate, that lower income segment is under immense pressure, right? And trying to cater to them with deep discounting would simply erode margins, making the entire business less sustainable.
Right, race to the bottom.
Exactly. They're making a calculated decision to focus on where they can thrive, rather than propping up a segment that's struggling across the retail landscape. The bet is that the higher income customer and the higher margins they bring will more than offset any lost volume.
That makes sense. Let's look at how this plays out in their updated fiscal year 2025 guidance. The company tightened its net sales outlook to $1.12 billion to $1.15 billion, which makes sense given the strategic focus on higher margin business.
Right.
But crucially, they raised the lower end of their GAAP EPS guidance to $1.70 to $2.10, indicating increased confidence in sustained profitability.
And that confidence really shines through in their gross margin guidance, which they raised by 150 basis points. They're now expecting 36.5% to 37.5%.
150 basis points.
Yeah, this clearly underscores a positive impact they expect from the Rebanner strategy. Capital expenditures are projected to be $45 million to $55 million, with a substantial chunk, $30 million to $35 million, specifically allocated to these Rebanner investments.
Right.
And management projects a strong 2-3 year ROI payback on those, which is a fairly quick turnaround for such a strategic investment.
That's pretty good. They even gave us specific Q3 guidance, didn't they? Net sales expected $290 million to $300 million, and EPS of $0.50 to $2.55.
Yep.
And for the broader outlook, they anticipate comparable store sales to improve from that high single-digit decline in Q2 to a low single-digit decline in the second half of fiscal 2025. All signs pointing to that tipping point approaching.
It is. Oh, and on the macro front, something to keep an eye on, the chief merchandising officer noted that while China tariffs were paused, new increases from Vietnam are emerging.
Always something.
Yeah. They anticipate price increases from wholesale partners between 5% and 7% for spring 2026 due to these tariff impacts. It's just a reminder that even a well-executed strategy still faces external headwinds.
True. So, given all this, let's talk about the market's reaction, because it was undeniably enthusiastic.
It was unequivocally positive. I mean, following the earnings call, the stock opened significantly higher, jumping over 16% from its prior close.
16%.
And trading up to around 21% intraday on really heavy volume. This massive trading volume signals strong conviction.
Yeah.
Investor sentiment was definitely bullish, but in a, measured, rational way. The market clearly rewarded the substantial EPS beat and the robust gross margin expansion, effectively prioritizing profitability and strategic execution over that modest revenue miss.
Right.
It's a classic case of the quality of earnings and the de-risking of the strategy driving the narrative.
And this aligns with broader retail trends we're seeing, doesn't it? Many retailers are struggling as lower-income consumers are pressured. Shoe Carnival's strategic pivot towards higher-income households seems like a smart way to navigate that challenging backdrop. But what are some of the continued risks or hurdles they might face, even with this pivot? I mean, the market loved this report, but nothing is a straight line up, right?
Precisely. No, you're right. While the pivot is smart, the execution remains key. The biggest hurdles will probably be maintaining the pace and quality of those rebanners, ensuring the new shoe station experience genuinely resonates with the target higher income demographic, and, managing the potential for cannibalization between the two banners.
Yeah, that's a risk.
And also, the macro environment could still throw curveballs, as that tariff discussion highlighted. But the market's current enthusiasm suggests confidence in their ability to execute. This strategic shift fundamentally reduces their exposure to that highly volatile lower income segment, and investors are clearly appreciating that de-risking.
Absolutely. Looking ahead, key catalysts for investors to watch include, the continued pace and return on investment of the remaining 2025 store conversions to Shoe Station.
Mm-hmm.
The execution during the upcoming holiday season, which is always critical.
Always.
And whether that positive momentum seen in August can be sustained outside of major event periods. This narrative is truly shifting from one of defense to one of profitable reinvention.
Well said.
Now, for our segment, this is not financial advice. As always, this is purely for entertainment and conceptual discussion, maybe like a hedge fund analyst pitching to an investment committee.
All right, team, let's talk about the next move for SCVL. Given the clarity on margin expansion and the accelerating Rebanner strategy, I'm proposing a leveraged bullish play here, something that allows us to capture significant upside as this tipping point plays out by mid-2026 while optimizing our capital.
Okay.
The core idea is really to position ourselves for a substantial re-rating of the stock's valuation.
Interesting. So for listeners who might not be options gurus, how would this leveraged bullish play fundamentally differ from just, buying the stock outright? What's the core bet you're making here? And why does this specific strategy enhance that bet?
Good question. Okay, so the core bet is that management's target of 51% Shoe Station fleet by back to school 2026 isn't just a goal, it's the actual inflection point. The point where we see sustained positive comparable sales across the entire corporation by the back half of next year.
Got it.
So instead of tying up a lot of capital and buying shares directly, this strategy involves options. Specifically, a combination of deep in the money calls and short out of the money puts, both with June 2026 expiration.
Okay, break that down a bit.
Right. The deep in the money calls effectively mirror a long stock position, capturing the upside as that tipping point plays out, but with significantly less capital outlay upfront.
Less capital, more leverage.
Exactly. Simultaneously, by selling out of the money puts with the same expiration, we leverage the current bullish sentiment, collect premium, and that further reduces our cost basis for the whole position.
So you're using the options market's belief in the strategy to fund the bet, partly.
In a way, yes. We're betting on that tipping point playing out. We expect that once over half the fleet is the higher margin Shoe Station, the market will re-rate the entire company. If they hit that 51% mark and deliver even low single-digit positive comps for the total corporation by next year's Q3, Q4, we could see a significant re-rating of the multiple, well beyond that initial 21% pop.
And the risks?
The risk, of course, is if the Rebanner ROI disappoints, or maybe the broader consumer environment deteriorates faster than their strategic shift can offset it. Yep. But their debt-free balance sheet and that growing cash hoard provide a substantial buffer against unexpected headwinds.
Right, that cushion helps.
Yeah. This strategy allows us to capitalize on a confirmed strategic shift with a highly capital-efficient approach. betting on that continued margin accretion and customer mix improvement that's already playing out.
That's a bold idea, for entertainment purposes only, of course.
Huh?
To recap, Shoe Carnival's Q2 fiscal 2025 earnings call highlighted a company firmly executing a strategic transformation towards a higher margin, more resilient business model through its Shoe Station Rebanner program.
Yeah, the strong EPS beat, significant gross margin expansion, and those positive August back-to-school results powerfully underscore the effectiveness of this strategy. And that led to that constructively bullish market reaction we saw. While near-term sales guidance was tightened, the raised EPS floor and that robust balance sheet truly signal management's confidence in sustained profitability and the long-term potential of the evolving store portfolio.
This transformation promises to reshape their customer base and market footprint in a fundamental way. So we leave you with this thought. As the tipping point for Shoe Carnival approaches, how will this strategic rebanner continue to influence the customer experience itself and potentially shift the dynamics of the broader footwear retail market, maybe forcing others to adapt?
Something to think about. Thank you for joining us for this deep dive into Shoe Carnival's latest.
Remember, this analysis is for informational purposes only and does not constitute financial advice. Always do your own due diligence. We'll catch you on the next deep dive.